Washington is in panic mode. The dollar is slipping, BRICS are dumping U.S. debt, and even longtime allies are shifting toward China's currency. Inside the White House, the message is simple. The dollar must be protected at any cost. But behind the confident speeches and tariff threats, there's growing fear that America is losing control over its most powerful weapon. It's money. For decades, the world relied on the dollar to borrow, trade, and save. Now that trust is fading fast. The dollar has already lost nearly 10% of its value this year, and global demand for U.S. bonds is drying up. From Asia to the Middle East, countries are finding new ways to fund themselves without relying on Washington's approval. As Trump races to restore confidence, a new reality is unfolding, one where the dollar's dominance is no longer guaranteed. Inside Washington, anxiety is running high. Every meeting, every press briefing now circles back to one question: how to stop the dollar from sliding further. Trump's latest push across Asia isn't just about tariffs or trade deals. It's about protecting the dollar's reputation. Treasury Secretary Scott Bessent's visit to Japan revealed this clearly. Instead of urging the Bank of Japan to raise interest rates, he focused entirely on keeping the exchange rate stable. A stronger yen could crush the dollar even more, and that's the last thing Washington can afford. So far this year, the dollar has already lost nearly 10% of its value. Global investors are backing away from U.S. bonds, once seen as the safest assets in the world. The problem is simple. If fewer countries buy American debt, the U.S. loses its biggest advantage: cheap borrowing. That fear explains why every policy move now aims to defend the dollar, even as markets begin to sense that stability is slipping away. The stage is set for a wider shift, one that will soon ripple through global finance as countries begin turning to other currencies for safety. Across global markets, a quiet but powerful shift is underway. Countries that once relied almost entirely on the U.S. dollar to borrow money are now looking elsewhere. In the first 5 months of 2025, the total amount of dollar-denominated bonds issued by non-U.S. governments fell by 19%, dropping to just $86 billion, the first decline in 3 years. For investors, that number might seem small, but it marks a major change in global sentiment. Borrowing in dollars has simply become too risky and too expensive. Rising U.S. interest rates and a falling dollar make repayment harder for foreign governments. Every fluctuation in the exchange rate now translates into bigger debt burdens, especially for developing economies. Countries are starting to ask, why should they borrow in a currency they don't control, especially when that same currency is being used as a political weapon? Sanctions, tariffs, and trade restrictions have turned the dollar into a tool of pressure rather than stability. For Washington, this trend is deeply worrying. Less demand for dollar bonds means fewer buyers for U.S. debt. For the rest of the world, it's an opportunity to diversify. Some nations are turning to regional currencies, others are strengthening their local markets. But one thing is clear: the foundation of dollar dominance, global trust and accessibility, is eroding. This retreat from dollar borrowing is slowly reshaping international finance, pushing more countries toward alternative funding systems, where Beijing is quietly building its own network of liquidity through the yuan. Indonesia's decision to issue its first offshore bond in Chinese yuan marks a major turning point in Asia's financial landscape. Known as a dim sum bond, it allows international investors to buy yuan-denominated debt outside China's mainland, giving countries like Indonesia new funding channels that bypass the dollar entirely. This isn't happening in isolation. Countries and companies worldwide are now issuing more and more yuan bonds. The total volume of these offshore dim sum notes has climbed about 8% over the past year, reaching roughly 720 billion yuan, or about $12 billion. The momentum has been building since 2022, when the United States began raising interest rates. Global markets are once again facing a dollar liquidity squeeze, but this time it's caused by nations deliberately shifting away from dollar funding, not by a shortage of credit. For Indonesia, the reasoning is clear. The country needs stable financing but also wants protection from the volatility triggered by U.S. trade policies. After Trump imposed a 19% tariff on Indonesian exports, the flow of dollar income began to shrink. Last year, Indonesia sold about $24 billion worth of goods to the U.S., while buying only $10 billion in return, a $14 billion surplus now at risk. At the same time, Jakarta is committing to new purchases worth $20 billion in American energy and farm products and $3.2 billion in U.S. aircraft, draining even more dollars from its reserves. If export earnings fall while dollar obligations keep rising, a liquidity trap forms. Borrowing in regional currencies like the yuan helps reduce that risk. By entering this expanding market, Indonesia signals that it wants balance, not dependency. And as more Asian economies follow, a new financial network is taking shape around China's currency, quietly redrawing the global map of capital flows. Across the developing world, the financial map is being redrawn, and China's yuan is taking center stage. Within BRICS and its growing network of trade partners, more governments and companies are now borrowing, lending, and settling payments directly in Chinese currency. Offshore yuan bond sales continue to expand steadily, with global demand climbing every quarter since 2022, when U.S. rate hikes triggered a worldwide funding squeeze. Between 2022 and 2025, the yuan had been under pressure. Back then, rising U.S. interest rates kept dollar demand strong, and China's currency weakened as trade with the U.S. was still relatively open. Now that dynamic has flipped. The tariff war is pushing global trade flows toward the yuan, not the dollar. And if the Chinese currency strengthens by just another 2%, analysts estimate that hundreds of billions of dollars could be dumped as importers and exporters rush to shift their reserves and settlements away from the greenback. This shift isn't just about politics or ideology, it's about practicality. As global borrowing in dollars becomes riskier, the yuan is emerging as a safer, more predictable alternative for trade partners who rely heavily on Chinese goods. And demand for those goods is booming. In September alone, China's overall exports grew by 8.3%. Electric vehicle shipments jumped by 11%, semiconductor exports soared by 30%, and shipbuilding exports surged by 40%. Every percentage point of growth strengthens the yuan's reach, since more buyers now need Chinese currency to pay for their imports. Inside China, the same trend is visible. In September, Chinese banks sold almost $52 billion of foreign exchange in a single month as exporters and importers converted their earnings back into the renminbi. This massive shift away from the dollar signals rising confidence in China's currency and reinforces its role in both domestic and global trade. From Asia to Africa and even parts of Europe, this transformation is accelerating. Countries are finding that using the yuan in regional trade reduces exchange rate risk and bypasses the need for costly dollar conversions. Beijing has quietly built an entire ecosystem to support this, clearing banks, currency swap lines, and digital payment systems that make cross-border yuan transactions seamless. As a result, what began as isolated financial experiments has evolved into a vast web of trade and financing channels revolving around China's currency. Each new bond, each new deal, and each new export contract expands that web a little further, tightening Beijing's influence and pulling more economies into its financial orbit. Back in Washington, Trump proudly points to the surge in tariff income as proof that his trade war is working.
We have an additional $31 billion, billion, not million, Lindsay, billion, that we just found from tariffs. They kicked in earlier than we thought. You were right. We're a wealthy nation again, and we're a nation that can be secure.
On paper, it sounds impressive. U.S. customs revenue has jumped 153% to almost $120 billion. But those numbers don't solve the deeper problem. Even with this extra income, the federal deficit remains stuck at $1.8 trillion, the same level as last year. The issue is that government spending continues to rise across every major category. Social Security, defense, Medicare, and interest payments on the national debt are all consuming larger portions of the budget. Interest expenses alone have reached a record $1.2 trillion. That means for every dollar Washington collects in revenue, 23 cents are used just to pay interest, the highest level in 25 years and double what it was only 4 years ago. This is what economists call fiscal dominance, when spending controls policy, not the other way around. Once that cycle starts, it's almost impossible to reverse. The U.S. can't meaningfully cut defense or social programs, especially during an ongoing economic confrontation with China. So the only options left are to borrow more or let inflation erode the debt's real value. Both paths weaken the dollar's credibility. As Washington clings to tariffs for short-term relief, The financial pressure beneath the surface keeps building, setting the stage for an even bigger monetary dilemma. Trump and Treasury Secretary Scott Bessent are running out of room to maneuver. The U.S. government has reached a point where every decision carries major risks. If they allow interest rates to stay high, debt costs will consume the economy. But if they cut too quickly, inflation will come roaring back. That's the dilemma now facing the White House and the Federal Reserve. Interest payments have already ballooned to over $1 trillion, and the pressure on financial markets is unbearable. Investors know the system can't sustain these levels for long. The only remaining option is to shift bond issuance toward the short end of the curve, 1-month to 12-month Treasury bills, where yields are lower and demand is still strong. At the same time, the Fed is expected to cut rates by at least 25 basis points, with markets pricing a 99.9% chance of it happening. Policymakers hope this will calm investors and buy time, but the trade-off is steep. Lower rates mean cheaper borrowing, yet they also accelerate the dollar's decline and deepen the process of debasement. If the Fed hesitates or fails to deliver, stocks and bonds could crash together, a scenario unseen in decades. Either way, the damage is spreading. Rate cuts might keep the system running, but each one chips away at the dollar's real value. The path forward is clear but costly. Maintain spending, print more money, and hope confidence holds long enough to avoid a financial shock. Trump's trade war was meant to weaken China, but it has done the opposite. Each new round of tariffs has forced Beijing to tighten its trade networks and strengthen its financial system. The yuan is now gaining value, and that shift is creating ripple effects across global markets. A stronger Chinese currency makes imports cheaper at home, boosting local consumption and giving Chinese families more purchasing power. For Beijing, this is a strategic victory. A more balanced economy with rising domestic demand to offset weaker exports to the United States. Meanwhile, Western companies are becoming more dependent on China's vast consumer base. European giants like L'Oreal, ASML, Mercedes-Benz, and Volkswagen now earn between 20 and 40% of their global revenue from China. This level of exposure means Europe can't easily follow Washington's lead on economic pressure. The U.S. is isolating itself through tariffs, while China is quietly turning trade ties into long-term influence. As the yuan strengthens and earns global trust, it's becoming a regional anchor for growth. Across Asia, Latin America, and parts of Europe, more trade is now settled directly in Chinese currency. The world's economic center of gravity is shifting eastward, away from confrontation and toward integration. The dollar's decline is no longer just about markets, it's about confidence. And that confidence is moving east, toward nations no longer waiting for Washington's approval to grow. BRICS countries are building their own systems, their own credit lines, and their own future. How far will this shift go? Will the world fully move beyond the dollar? Or will the U.S. strike back to reclaim its dominance? Share your thoughts in the comments, and don't forget to like and subscribe as we track this unfolding economic shift.